I think this mini rally we've seen in the FTSE 100 since mid-February, it's been significantly based on a recovery in oil prices from historic lows. I mean, it went down to about $25 a barrel. A lot of excessive short selling going on by opportunistic traders, which was closed out. And so purely actually on that short closing, there's been a significant re-rating in oil prices, which has got tied in with an expectation that oil producers are going to be able to agree some kind of production freeze or cut even. But I think this is overly optimistic, and that we're going to see quite a moment of truth. It's already coming into the oil markets, which are seeing oil prices retreating from $40 a barrel currently, because I just don't think the producers are going to be able to get a significant cut achieved. And if they get a freeze even, that is going to be at very high production levels. So we've got this excess supply, excess storage, and we're going to see oil prices easing back again. That's actually has tied in very closely with risk appetite. It explains why we've seen the FTSE 100 driven by, for example, indebted oil companies and miners in particular, driving the index higher. And so I think we're naturally going to see some profit taking, because the global context is still one of weak growth. We're just about now to go into the first quarter results reporting for US companies, where expectations are we might even see something like earnings per share going down across the board, something like about 8%. That can start to dent sentiment. And then as we move into the later spring and summer, of course, we've got the Brexit problem here, that international investors are going to be looking at the opinion polls and fretting. So I'd expect to see, kind of like the discount factor of a Brexit starting to get priced in both to the UK market and to sterling. We're just going to have to see whether a vote leave then results in a rebound, but I'd stay quite cautious for the time being. One of the companies that's caught my attention again, actually, Burford Capital. This is an AIM-listed specialist in litigation finance, which involves taking a view on the outcome of litigation cases internationally. It's a specialist area. There are very few rivals. Indeed, in the listed company domain, very hard to find anything even in the US that compares with Burford. And there's certainly nothing else on the London market. I drew attention to it 2 years ago at about 130 pence a share, fairly soon after the listing. It's made very good progress. I drew attention to it again in January at 220p a share. Came out with extremely good results, earnings per share progress around 40%. It has a return on net invested capital of 71%. Non-executive director was buying 236% pence, but since the results, the shares have gone on, carrying on up to about £3. Now, we know when you look at the actual chart, it's going up very strongly, but this company could still, unlike on a 3-year view, be worth a great deal more than its current £600 million capitalisation. It just doesn't have any other capable specialists. It's the global leader, and litigation is going to continue, irrespective of whether we have a recession, an upturn, deflation, whatever. And secondly, Sports Direct. This is more of a contrarian play, where the stock price has taken a big dive, largely on media criticism of the company's employment practices across its warehouses. And also it has a maverick founder, Mike Ashley, who is sort of making a bit of a war for himself against the city, and this never ends well. So the market is prejudiced against the company at the moment, and so we've seen the overall rating come down to about £2 billion, but within that we're looking at an earnings valuation of only about 10 times. There's no dividend yield, but as a result of Ashley's maverick share dealings, the group also has about £500 million worth, it's estimated, of different shareholdings, mainly UK and US, which, when you look at it from a sum of the parts perspective, implies there should be an attractive risk-reward profile at this current level of 370p. Now, the story could get a bit more difficult given the criticism of the company, and also it has some headwinds against the US dollar at the moment, but in terms of its importing, but on a longer term valuation perspective, it's one that's caught my eye. I think it's a case of making your own luck, because if you do target companies that are, say you've got modest share ratings and they've got strong positions in their market, then these will always be attractive to predators. But currently, given the cautious macro environment, it's more difficult for bigger companies to achieve revenue growth organically. And also tied in with the relatively low interest rates, this makes takeovers an attractive move for the larger firms, as we've seen with the moves on Home Retail Group, which was hugely out of favour, one of the most shortest, stocks most shorted on the London market, but there's been a significant takeover move there, and also for Premier Foods, which again was well out of favour. And I expect this to continue, so it's going to be an attractive area for those special situations. I think I define satisfaction in terms of finding an actual business theme that's validated over the medium term, kind of like a 2-year view rather than too much like short-term trading in a stock. And a couple that I draw attention to and are still well placed. JD Sports Fashion drew attention to 2 years ago at a price around 250p. It's come up even like above £11. A significant re-rating of earnings due to the company getting its marketing right. And it's achieved in the last Christmas trading period 10.6% like-for-like revenue growth. Where do you find businesses that are doing as well as that? And even in the challenged retail environment. So it's a very good performance there. Secondly, the Tritax Big Box Real Estate Investment Trust. Quite a mouthful, but a neat, interesting concept. This company was established by property specialists to target warehousing that would service the growth in online retailers. With the amount of home deliveries that are taking place nowadays, you can see that that's a growth trend significantly underway, and that's here to stay. Also, some of the big supermarkets have wanted to divest their warehouses to raise cash and put that under the control of a specialist. So the theme was immediately attractive, drew attention to Tritax around its £1 flotation value a couple of years ago. It's come up to about 135p, still quite modestly rated, only a small premium to its net asset value, still well positioned for the medium term.